So today, let's talk about the stock market, the inflation, and the risk of recession because it seems like currently everyone is convinced that a recession is on the horizon, about to happen, and the economy, at least in the short term, is doomed to underperform. In fact, I even conducted my own poll on this channel, and most of you guys watching are in this boat. And we're about to go over the data. I'm going to present my viewpoint, but I have to say, I disagree with this. I do not think at least a major recession is going to happen really anytime soon. Now, of course, the major reasons behind the recession fears is because the stock market is down roughly 20% for the year and interest rates are on the rise. But I have to say, just anecdotally, the fact that everyone is expecting a recession, the stock market is reacting, pulling back, correcting in price, all of that is a healthy thing in my opinion to help avoid an actual recession. Because you would be surprised just how much of economics is dictated by human behavior. This might seem counterintuitive, but right now with the fear and greed index being so far on the fear side, that actually makes people more conservative, take on less risk, which is essentially the opposite of, say, '08, when everybody was doubling down, taking out more mortgages, making the problem worse. Now, as promised, we're going to be diving into the data, but first, really quick, I want to read some of this article talking about how inflation might have already peaked. Whether you're an average American, central banker, CEO, or parking attendant, inflation is now the primary economic concern for most Americans. Polling bears that out. For the first time in decades, a notable portion of Americans say inflation is the number one issue facing the country. The most recent report showed prices up 8.3% year over year. And then the article goes on to list the reasons of why we have this record inflation that we're all pretty familiar with. But down here towards the end, they have a pretty good summary I want to read. So it says, the burst of inflation the past months makes sense in the context of lots of government spending, pent-up demand, global supply chain disrupted by the pandemic, and politics, and then the commodity shock of the Russian invasion of Ukraine. All of these are indeed transitory, even if the length of the transitory is longer than a brief few months. But that is a far cry from chronic inflation that now requires draconian action on the part of central banks. Some of that goods and service inflation has been byproduct of rising wages for the lower income tiers, which is unquestionably a good thing. It would be a travesty if in trying to dampen inflation, policymakers managed to increase unemployment and lower wages. Now, luckily, policymakers are somewhat intelligent people. I know that's a hot topic right there, but they understand the balance they have to keep between inflation and the health of the overall economy. And to make the proper decisions, they're looking at the data. So let's take a look at that ourselves right now. Okay, so I'm breaking this up into three main categories. The first is the Fed and what they've directly done. The second is the people and the overall economy. And the third is, let's call it Russia or geopolitical tensions. So beginning with the Fed, this is a play-by-play of what they've done so far. So of course, in 2020, in response to the pandemic, they slashed the federal funds rate to essentially zero. At the same time, if we come down to this graph, they drastically increased their balance sheet to help stimulate the economy and put money into the system. And that resulted in the M2 money supply having this huge increase beginning in 2020 and really continuing until very recently. So just looking at this data, we can see a big part of why inflation is so high. They simply injected a lot of money into the economy in response to the pandemic. Although if you take a look at the most recent kind of few frames in all of these graphs, you can see the trend beginning to reverse. The Fed has stopped increasing their balance sheet. In fact, they're beginning to sell off assets, which directly removes money from the economy. And the interest rates are beginning to increase, roughly 50 basis points every couple of months. Now, these actions alone do not fully explain the inflation situation in the economy. For that, we need the other section of the equation, which is the people that actually make up the economy itself. And here we have some data on them. So this first one is the personal consumption expenditures, so how much people are spending within the economy. Of course, we can see in response to the pandemic, it had the sharpest decrease in history, but that quickly rebounded and now we're near all-time highs. And this is important because the more people are willing to spend, the more companies can raise prices, increasing and contributing to inflation. And the second piece of data here is the total business inventories. And this has to do with supply chain and the shortages we're all familiar with, because this also directly contributes to inflation. When there's less of something and the demand is still high, the price increases. And the story here is pretty similar. So during the pandemic, companies slashed their inventory because the economy was shut down, and nobody knew what was going to happen. But the Fed began printing money, so that gave people confidence to continue to buy, and that caused a lot of companies to play catch up, have to increase their inventory, and it contributed to all of these supply chain issues. But now we can see the inventory levels are very high. And when it comes to personal expenditures, aka the demand in the economy, this came back way faster than the inventory levels, which makes sense because we have global supply chains. It takes time to restock inventory. And in terms of a recession, usually when there's a recession, the demand and spending decreases within the economy, but we have yet to see this. And in fact, if we do begin to see this happen in the next couple of months, that could put downward pressure on prices because inventory is at all-time high. And then in order to sell this inventory, they have to conduct sales, lower prices, conduct more marketing, and that can help to combat inflation if the demand decreases. But potentially one reason demand is still high is because wage growth is at a pretty high historical level. We can see wages in the United States increased 11.67% in April of 2022 over the same month in the previous year. So that's a very good sign for the economy. Wages are continuing to increase. And then this final piece of data I have on the consumer has to do with their personal savings rate. And this tends to spike during recessions and uncertain times, and that's exactly what happened during the pandemic. But now we can see that the personal savings rate is near an all-time low, meaning that the consumer has a lot of confidence, they're spending a lot of their potential higher wages, and it confirms this first graph of consumption expenditures. And again, during a recession, you would expect the savings rate to go up, wages to decrease, inventory to decrease, and expenditures to also decrease. But we see the exact opposite right now. And when this does change, that's going to drastically help to fight inflation, which could prevent the recession that we're all afraid of. But we do have one more category of data here, and that's the geopolitical tensions, aka Russia right now, because this is a second wave of inflation causing activity that we weren't expecting on top of the pandemic. And this has to do with commodity prices, and it explains why food and gas is going up. So this first graph is the price of wheat, and right after the invasion, we can see the massive jump in wheat prices because the Ukraine-Russia area is a major producer of this commodity. And the same exact thing goes with oil. And again, when the prices of these commodities go up, that contributes to inflation right here at home, even though it's pretty disconnected, and these eventually will come down in price by themselves naturally. And finally, all that leads us back to the current inflation rate, which as of April 2022, it was 8.3%. Now we have a fresh CPI report coming out on June 10th, so pretty soon, and that's going to show us what it was in May of 2022. And keep in mind, this is a lagging indicator, so a lot of this inflation right here was caused by all of the money printing that happened right as the pandemic started. And in terms of the trend here, you can see how it's beginning to flatten out and eventually could roll over. Now coming back to the data, the Fed is currently trying everything they can to ensure that this happens by increasing the interest rates and selling off their assets. The next thing that has to happen for inflation to truly inflect downward is by the consumer. They have to stop buying so much and increase their savings rate. And the third and final major factor is the commodity prices. These have to naturally come back down over time, and that's going to help ease inflation. And that's why I don't think a recession is inevitable, at least a severe recession, because usually when everybody's expecting something, whether it's a recession or that the stock market's going to continue to go up forever, usually the opposite thing tends to happen. And that's why when you go against the grain as an investor, that's when you tend to make outsized returns. So when everyone's fearing a recession, there's blood on the streets, the stock market's down 20%, everything looks like doom and gloom, this could be the best buying opportunity. And I'll leave you guys with this final piece of data. This is the gross domestic product of the US. And during a recession, you would expect this to decrease. But so far, it's really not the case. It does seem to be slowing down, but it's coming from a very fast pace of recovery. But I definitely don't see a massive decrease happening in the immediate future. So currently, to sum this up, I just see a lot of ways that inflation can be dealt with. And a lot of it comes down to the individual and just spending less money. Right now, they're spending a lot of money, and that's not really indicative of an economic recession. We definitely have to keep an eye on the inflation report coming out June 10th to see the direction and the trend line with inflation. But keep in mind, that's going to be skewed a lot because of Russia and commodity prices, which will eventually come down by themselves. But let me know your opinions in the comments below. Hope you guys enjoyed the video. If you did and you're still watching, I appreciate a like on the video. Go ahead and subscribe for future content. And I'll see you guys in the next one.